So, hello everyone. Thank you to be here for this last session of the day. And this session is dedicated to insurance and cyber risk. And we will have 3 speakers and 2 discussants. And we will start with Olivier Lopez. We'll talk about parametric insurance. So, Olivier.
So hello to everyone. So first of all, a disclaimer. I will talk about cyber risk, but only in an application in the end and also in the introduction. But my talk will be mostly related to some work we are doing with a PhD student and a former PhD student, Daniel Nkameni and Antoine Eranval, on parametric insurance. So, as I said, first slide related to cyber, just to explain, to illustrate a little bit the application we will see at the end of the talk. So here you see a map of one big contagious cyber event in 2017, which was the WannaCry attack. So I will not describe it extensively, but the idea is that you have lots of victims. You see around 300,000 in approximately 1 week, and an amount of loss which is relatively huge, $4 to $8 billion. And it's a ransomware attack, so you see the information system is blocked unless you pay a ransom. But I mentioned this example just to show the comparison between what was paid for the ransom, because we know precisely what was paid, because it can be related to some Bitcoin addresses. And you see that it's quite small compared to the damages, because in fact the damages are caused not by the ransom, but typically by business interruption. So you see, for example, this slide just to explain some framework, which is usually how it is done to model the business interruption. Here you see the graph is an example from a report from the Lloyds on what happens when a cloud is down and how the business interruption cost evolved through time. So typically it's something you see at the beginning. I don't know if I press that. No, I do not have any pointer. Okay. So at the beginning you have a total loss, total business interruption. Then you have a backup plan, and so the cost per amount of time decreases, and then you have a progressive return to normal. And so in this case, typically the cost is very much correlated with the different times you see the first, the total duration of the service interruption, and how long after business interruption you have the occurrence of a backup plan that can reduce the amount of the loss. So what about parametric insurance? So typically this is not specific to cyber. Parametric insurance, it's a tool to replace the fact that you need in traditional insurance to know the amount by paying an amount very fast just after the occurrence of the claim. So typically why it's the loss of the policyholder, the true loss. If you are in traditional insurance, you need to determine this loss, and it can take some time because you need to send an expert, and the payment is not fast. On the other hand, you have parametric insurance where you observe information covariates typically just after the claim, and from that you can build an index and compute a payment which, and its content should be essentially smaller than Y in most cases. Otherwise, you can have a problem related to the fact that you have enrichment without cause of the policyholder. but you win because you receive the payment faster, and of course you have less cost for the company because you do not have so much claim management as in the first case. So typically, if you look at cyber, essentially you have already products that exist, and essentially they are more or less related to this question of business interruption time, or also to the volume of data that are exposed. So, of course, here it's not parametric insurance, but it's something which is quite close. You have many examples of index-based product where you have issues because the product fails to trigger when you have some catastrophic events. So here I give this example of the pandemic bonds. So the pandemic bonds also an index. You compute an index, and if this index is too high, then you send a compensation to the countries that are exposed to a disease. And here you see for an epidemic of Ebola, this pandemic bond failed to trigger, and it made lots of noise in the press, of course. You also have examples related to hurricanes in Jamaica last year, I think, or 2 years ago. And so there is also this question of the basis risk, understood as a difference between the true loss and what is compensated, and also about the ability of the product to trigger or not. That creates lots of tension and potentially doubts about parametric insurance. So here, what I will describe here, it's first some very brief presentation of some utility theory to describe that we need a product that matches the preferences and the expectations of the policyholder, and also with a small model on demand in insurance, which is related to that. Why a model on demand? Because we want this product to be bought by a significant number of policyholders, otherwise you do not have mutualization. And so there is this constraint that will allow to explain what I mean by viability of the portfolio, but it's directly linked to the fact that we need to have enough policyholders to achieve, to reach mutualization. And then instead of opposing parametric and traditional insurance, we will explain how we can optimize the trigger mechanism, use parametric insurance only in a certain number of situations, but I will explain that later. Perhaps another disclaimer also, I will stay in a world where things are insurable, in the sense that you often mention parametric insurance as a solution to reduce protection gap, especially for risks that are not insured. So that's actually the topic of another paper we did with Daniel, and which is a preprint right now, but here I will stay in a world where you have already traditional insurance. You need to adapt if you want to consider this other situation. So regarding utility theory, I will be very brief because it's quite classical, but the idea is to describe the preferences of the policyholder, its satisfaction through a function that has to be concave. Concavity is related to the fact that we want to model the phenomenon of risk aversion, in the sense that you tend to prefer a situation which is not risky when two situations have the same expectation. So after 1 year, the policyholder has an initial fortune U that I will skip in this presentation. He experiences the loss Y, he receives the compensation Z, and then you have a premium, which is the average value of the compensation plus some loading factor, of course. And so since it is random, you describe his future satisfaction via the expectation of this utility function. And the idea is that the consumer will prefer among different product Z, the one that provides the most interesting expected utility. So you can build some very simple, you have other way to consider the demand in insurance, of course, but you can consider one of the most simple models that you can consider. You look, in fact, at the expected utility of both situations. So I cannot point, but if you go directly to the set big A, you will see the first utility function is applied to what happens when you subscribe parametric insurance. And on the right-hand side, you have what you get if you have a traditional contract. Here in the traditional contract, we put some exponential minus tau, which is related to the fact that, of course, you can take tau equals 0 if you consider that the policyholder wants to receive the more money as possible and there is no impact of time, of delay in receiving the compensation. But here, expectation minus tau is here to describe the fact that the policyholder prefers to have something fast. And so here you compare these two expected utility, and if the expected utility is larger in the parametric case, then you choose the parametric contract. Here you see some alpha, which is in fact a parameter related to the individual behavior of the policyholder. Typically, if you consider the exponential utility function, alpha, it's a parameter describing risk aversion. The higher alpha, the more risk adverse you are. And so you have people in the population with different types of risk aversion, of course. So, regarding the viability of the portfolio, the idea is here what you see. It's within the probability here, it's the loss experienced by the insurance company if you sell some parametric product. So you have the claims, FWI, and then you receive the premium. You're not necessarily, you do not necessarily need to put 0. You can also consider some capital that has been invested by the company, but here it's the probability of losing money, and you should control that. You should have this probability less than some epsilon. And of course, if you make some Gaussian approximation, you see that to bound this probability, you need to load the premium with some factor theta phi larger than 0. And of course, the more policyholder you have in your portfolio, the lower the loading factor, because you have this phenomenon of mutualization. So the idea is if we want to offer a loading factor which is small enough, because let's recall that if we reduce the loading factor, you attract more people, so you will increase the size of your portfolio, and you will be able to achieve this kind of solvency condition more efficiently. On the other hand, you see what can happen in some cases. If you have n too small, you tend to increase your loading factor, but then you're not sure to be competitive with traditional insurance. I will be very brief about that, but just to say that in the paper, here we will first consider that policyholders are IID, but typically in parametric insurance, especially if you want to apply, for example, to agriculture or even in cyber, where people are very dependent from each other, you can have some catastrophic episodes. And so the way we introduce it in a very simplified way is to make some shock, unexpected shock, and so you have a V-tail variable that you add to the loss, and that is triggered if you have some massive event, for example, that could disrupt the portfolio. Very short about that, but just to say that I will show the results in the IAD setting, but we also consider the case where you can have some distance to this assumption. So going to some quite simple results, in the case of the exponential utility, you see that the following proposition tells you what condition on the loading factor you should put to be more competitive with the parametric product than with the traditional insurance. And typically, it's related here to a condition on the log Laplace transform, and essentially, it also explains why I cannot discuss here with this simple result the question of the protection gap, because we assume here that the variables have a Laplace transform, which is not the case for some AV tail risk, and so you need to adapt. So typically, this result tells you that the loading factor should be less than some upper bound. And then you also have a condition that tells you what is a sufficient condition for the portfolio to be viable, and it shows that the loading factor should be smaller than some condition here. What is important here is that you see at the bottom at the denominator of the first equation, you see a measure mu that I did not mention. It's the repartition of the distribution of the risk aversion parameters within the population. We have a cryptic function h related to the delay, of course, but the more people are reluctant to receive payment late, the highest this function, and then it allows you to improve a little bit the bound. So regarding here this condition, typically you see that the question is related to this difference between the log Laplace transform and the expectation and the conditional expectation of y, because I did not mention that, but it's in the case where the payoff is the conditional expectation multiplied by some factor that is less than 1, because again, you need not to overcompensate. So usually you are ready to pay, the policyholder should be ready to have something a little bit less than what you would get in the central scenario to avoid overcompensation. And so typically it can give idea on how to define rules to combine traditional and parametric insurance. And that's what you can see here in the type of product. I will be quite fast about that. But typically, we have, if the index are in some region of the covariate space, then you trigger parametric compensation. Otherwise, you trigger traditional insurance compensation. And the idea is to define the region W based on the difference between the log Laplace transform and this conditional expectation up to the multiplication by a constant. And so based on that, you have a condition that appears and that shows how to define optimally the region on which you rely on parametric insurance and traditional one. I'm a bit fast because I have a few time left. So I will be also very brief about the application, but it's in an application in cyber. If you are interested, everything in the paper explains how we can calibrate roughly the model, because the key question is how do you calibrate the utility function. So here you have an explanation on how we calibrate it in this case. And then you have two studies on, so you see here, you see decision tree that will be computed to define this optimal region. So you see, depending on the time of business interruption and some condition, you will either use parametric insurance in green or traditional one. And just to mention that in the database that we considered, you see a difference between the companies where you have a backup plan, that is, companies that are prepared to act in case of cyber and to work in a let's say, discounted way. Here you see, here it's for in case you have an event where the company managed to trigger a backup plan, you have a decision which is slightly different in terms of regions, of course. So here you see in this model it's very simple in this case because we have very few covariates, but typically you decide to rely on parametric insurance or not based on the time of interruption and the ability of the company to have triggered some backup plan, typically. So I was very short and fast on the last part, just to discuss a little bit about the extension. I already mentioned the question of the protection gap, which is actually in another preprint. The idea is also that you can use everything that I mentioned, not only for parametric insurance, but to optimize the way you perform claim management even in traditional insurance. In traditional insurance, for example, when you have a catastrophe, you can, for example, propose to your policyholder not to send an expert, but say, okay, I give you this amount. And so there is a little change to make to the model to consider this situation. This change is essentially to introduce some probability for the policyholder to accept this solution or not, but typically the idea is the same, and the idea is to design rules that allow to optimize how the contract works. Okay, so thank you for your attention.
And before taking questions, so the second speaker is Beatrice Ongarato from University of Padova, and she will talk about a dynamic version of Gordon-Loeb model for cybersecurity investment.
Thank you, Caroline, for the nice introduction. So today I will present you the joint work together with my two PhD supervisors, Giorgia Callegaro and Claudio Fontana, and Caroline. So what we investigated was the optimal investment strategy for a company attacked by cyber attacks. So in the presentation, first I'm going to speak a little bit about cyber risk. Then we're going to see this Gordon-Loeb model, so the original model and its dynamic version. Then we're going to see what optimization problem we wanted to solve. And finally, we're going to observe some numerical results and some future development of this work. So regarding cyber risk, it is really important to notice that it is one of the most relevant type of business for business risk for financial institutions. That's what this own Global Risk Management Survey states. And this is also stated by IBM, which claims that the average cost of a data breach is of about $5 million in 2024. And here I have a timeline of big cyber attacks which happened from 2015 to 2024. And if you observe the numbers of damage in these attacks, they are huge. For example, with Olivier, we saw the WannaCry attack, but with the 5 billion of damage, of losses, but also we're speaking of 10 billions or millions of documents stolen. So this slide tells us that it is really important for companies to architect effectively against cyber risk to avoid having such big losses. So, however, there are a lot of challenges connected to cyber attacks. In particular, there is some limited historical data. Indeed, companies are often not willing to share if they were attacked or not. And moreover, it's hard to create a database regarding these cyber attacks. Moreover, we're talking about a dynamic risk type. Indeed, cyber attacks evolve together with technology, so it is a risk that it changes over time. And moreover, it is characterized by some interdependence and accumulation risk, as attacks are often correlated and counts in clusters. Finally, it is difficult to determine the impacts of these attacks, as the impact is made of different features. For example, it might be money losses, but also reputational losses. So it is difficult to really determine the losses which comes from an attack. So in our work, we decide to work on the second and third challenge, let's say. And what we want to do is to develop a model and an optimization problems which tell us how to react effectively to cyber attacks. And to do that, we study an optimal security investment with a stochastic control approach. So the two key questions we want to answer are: what is the optimal amount an entity should invest in cybersecurity, and which is the benefit that comes from these investments? And these two questions were first answered by Gordon and Loeb in 2002. And in particular, their model is simple, and it describes how an attacks arrive to a system. So their aim is to determine, as ours, the optimal investment. And they described an attack arrival as described by three components. First, we have the potential loss associated to an attack, so this L. And then we have, and this attack can arrive with a certain probability P to the system. At this point, the system makes the attack penetrate or not inside, depending on the vulnerability V of the system. So the attack penetrates with a certain probability V, and in that case we have a loss L, and it does not penetrate with a certain probability 1 minus V. So in that case you have no loss. And what Gordon and Loeb assume is that we can invest some money to decrease our vulnerability. So what we can do is to make some monetary investment Z, and investing Z, our vulnerability becomes a function of our initial vulnerability V and of Z. So we have this security breach probability function, and so we have that the attacks penetrate inside the system with a probability S of Z of V. This function has to respect some assumptions. In particular, of course, if the system is invulnerable, it stays invulnerable. If you invest no money, you cannot change the vulnerability clearly. And we also ask for S to be decreasing in the investment and convex. And so Gordon and Loeb, to find the optimal investment, they study this cost-benefit trade-off. What they do is that they have a benefit which is represented by the first term, so it is the difference of the expected loss with and without investment, and they subtract the cost of investing in cybersecurity. Solving this problem is simple. You just find the Z which solves a first order condition, and what is interesting about this model is that they find a benchmark for some specific function of S, where they say that the optimal investment should be always less than the 37% of the expected losses. So we decided to start with this model because it's very simple. So there is no dynamicity, no stochasticity, but it is still interesting. First, because it provides some benchmark on the overall investments, and then because it leaves a lot of space for extensions. Regarding extensions, there are a lot of paper which works on a more complex model of Gordon and Loeb, for example, considering more complex functions S, or some first dynamic extensions of the models, or also trying to apply this model to cyber insurance. What we did is to propose a dynamic and stochastic version of this model. So we're working in a probability space, and we take into account a accounting process N, which counts the number of cyber attacks. So then to each attack, we associate a certain potential loss, eta I, which is a random variable, which has some expectation bar of eta. And so you have these attacks, and each attack is associated to a certain loss. Then, similarly to Gordon-Loeb, what we can do is that we can invest in security, and we have an investment rate, so a center rate ZT that we can invest at each instant of time. And this is the process we control. So we take into account the fact that the most recent investment should have a bigger impact in reducing our vulnerability. So we consider a decaying factor rho, and we consider, instead of just the integral of z, cumulate this function h, where we model the fact that most recent investment should be more meaningful. Then, having these objects, we consider these three compound processes. So the first are the potential losses, so the losses that we have if potentially. But since our system has a certain vulnerability, what we really should look at are losses in red, so LT0, which are the losses you actually have if you don't invest in security. And they are modeled by a compound jump process where the marks are given by the multiplication of the random variable eta I with a Bernoulli random variable, which is 1 with probability v and 0 with probability 1 minus v. But since we can actually invest in money, we should also look at losses with investment, which is, again, a compound jump process, but in this case, the marks are given by the multiplication of eta I with a Bernoulli random variable whose parameters depends on our investment h. So this is our model, and what we also assume is the dynamics of our counting process n. In particular, we assume n to be an Hawkes process. Hawkes processes are jump processes where their intensity, so the probability of having a new attack, is given by the lambda t there. And what is characteristic of this kind of processes is that lambda depends on n. So what you have is that when n jumps, also lambda increases, so you have a higher probability of having a new attack. And this is called the self-exciting property of Hawkes processes, and it is good to describe the possible attacks that your system can have after a big first attack. And there are also some statistical evidence, especially in a paper by Baldwin in 2017 and by Bessirolan and other authors in 2021, where they actually study they make some statistical tests and prove that Hawkes processes are good to describe the arrival of cyber attacks. Okay. And finally, we arrive to the optimization problem. We want to work on a similar setting to Gordon-Loeb, so we still study a cost-benefit trade-off. So we want to find the optimal investment such that we maximize a benefit, which is represented by the difference of the losses with and without investment. Then we subtract some quadratic cost, and in the end we consider some terminal utility, which represents the fact that also terminal time t, the company does not stop existing. So we want to take into account that we invested in cybersecurity for the future. So we can compute explicitly that expectation, and so our problem can be written in a simpler form. And in particular, we consider all admissible control, which are non-negative, of course, because they are money, and which are predictable with respect to the filtration generated by the counting process N and by the losses. So this is the problem we want to solve. To do that, we use the dynamic programming principle techniques, which means that we can write the value function of our problem. So we can write the maximum value we can obtain starting at some initial time t, initial intensity lambda, and initial investment h. And this value function can be characterized in terms of a partial integral differential equation. So it can be obtained solving that PDE. And we can also characterize the optimal control as a function of the value function. And in particular, what that optimal control tells us is that we should invest in security if the benefit we obtain by doing that is bigger than our marginal cost. Otherwise, it is not worth it. So to solve the problem, we just need to solve the PID. To do that, we used a numerical scheme. So what we did was to discretize the space states. So the derivative with respect to lambda and the derivative with respect to h, and then we were able to write the problem as a system of OD that we could solve numerically. So this was the scheme, and these were the parameters we used for the function S, so our new vulnerability. We used some parameters in literature. For the Oaks intensity, we used some calibrated parameters by a paper, by a recent paper in 2023. And for the optimization, we used, let's say, reasonable parameters, because it's really hard to find real-world parameters for that. So, and finally, we can discuss about the practical implications of this problem. What you observe is the value function, so your benefit. And what you can see is that, and in the first image, you have your benefit for the intensity fixed, and in your second image, your intensity for your investment fixed. So in the first image, you can observe that your benefit is increasing in H, so increasing in the investment. The reason is that if you have a larger initial investment, then you have a larger benefit. In the second graph, you can observe that our value function is increasing in lambda, because if you have a larger risk, you have a larger benefit if you mitigate it. And lastly, in both graphs, you can observe that our benefit is decreasing in time, as when we go very close to maturity, our benefit is less significant, as we are very close to the end. And we also have analogous graphs for the optimal control, and we observe a similar behavior for lambda and t, but what we observe is that the optimal control is decreasing in h, as clearly if you have a larger initial investment, then you should have a smaller investment afterwards. Okay, what we wanted to do numerically is also to discuss the practical implications of this problem. So we made a comparison of our dynamic stochastic strategy with a completely static one. In particular, so we choose static control Z of GL, which we choose comparing that to the original Gordon-Loeb benchmark. And then we computed the gain and the percentage gain of our benefit with respect to the one obtained with the static control. And what we obtain, especially looking at the percentage gain, is that, okay, the gain is decreasing in time, because of course if you're very close to maturity, you don't have a big gain, but really close to the initial time, we have around 20–25% gain. So it is a big gain with respect to a static strategy. And last, our last experiment is to compare our problem with the same problem, but not considering an Oakes dynamics, but a standard Poisson dynamics. So Oakes intensity is dynamic and it changes over time, while for the Poisson you can assume that the probability of a new attack to arrive is always the same. So we choose the Poisson intensity in such a way that the average number of attacks for the Poisson and the Oakes are the same, and then we computed the value function and the optimal control. And here, in these two pictures, we have the value function and the optimal control for a fixed lambda. And in particular for the intensity equal to 3.25, and what maybe you cannot observe really well, but what happens is that the benefit is always bigger for Oakes, and also the investment is bigger in the Oakes case, even though you're assuming the same expectation. So this tells us that even if you estimate correctly your intensity, but you assume it to be constant, this might lead to some suboptimal strategies. And to do a similar experiment, and I also wanted to observe what happened to the optimal control when we look it along one particular trajectory. So here on the left-hand side, you observe the intensity of the Oakes compared to the intensity of the Poisson. And what you have, looking at the control, is that the Oakes control clearly jumps when you have some jumps in the trajectory. And in general, it is always higher than the Poisson one, except for for the time before the first jumps. And so what in the end we obtain with this model is that first we extended the Gordon-Loeb model using this counting process for lossing and Oakes process for cyber attacks arrival. Then we formulate an optimal investment problem, and we solved it, and we characterized the solution through a PIDE that we solved. And then we made some experiments to prove that using a dynamic strategy instead of a static one can lead to around 25% gain, and also that ignoring the dynamic attack intensity could lead to some suboptimal strategies. And so we are doing also some, we're still working on this problem. In particular, we are working on some theoretical study of the problem, as we need to characterize better the value function. But we also wanted to work on some more practical extension of the problem. In particular, we would like to introduce insurance. The company can subscribe under insurance contract or invest in security. They can allocate different their money, and that might be interesting to study. And then we would like to also consider, for example, the control to jump, so consider a larger setting for the control, or more importantly, to consider a partial preservation setting. So in this case, we assume that we could observe all the attacks, but this is not true in practice, as you can observe probably only the attacks which penetrates into the system. So it might be interesting to study the problem under this context. And that's everything. Thank you very much.
So, I will invite Sébastien Farkas from Allianz to start the discussion, and then we can take a few questions in the audience.
Thank you very much, Karin. The aim of the discussion is that I ask a lot of quick questions to the authors. Yes. That's it? Yes. Okay. Okay. First of all, I would like to thank you all, both of you, for the very good presentations, and the papers are also well qualitative. So I'm not an expert on optimal control, neither on utility, but I am quite interested about cyber risk. So I'm going to try to summarize and maybe to raise some questions that was raised to me. So you both of you took the same example about WannaCry. That was interesting because you say that the number of ransom paid can be known using the Bitcoin historic. I think that's maybe interesting because we know that there have been more than 300,000 computers impacted, and if we compare it to the number of ransom paid, it can be interesting to understand the frequency the businesses can pay some ransom. So regarding the first paper about parametric insurance, I would like to raise you one question, Olivier. You took the business interruption time as a proxy of the loss, and I think indeed it's a good proxy, and you modelize the demand regarding utility. My question would be, can anti-selection can be taken into account regarding this demand? Because maybe the customer that are interesting regarding parametric insurance as huge businesses that have the ability to assess the risk. So I think that it would be interesting to take into account this anti-selection within this demand, and maybe it would be interesting to elaborate a little bit more because you do not have enough time about the choice, the optimal choice between parametric insurance and traditional insurance for a business, depending on their anticipation of the risk. And regarding the second paper, so thank you again, Beatrice, for your presentation. So I really like the split between three parts of the risk. So the hazard risk, the vulnerability, and the exposure. And you take out the hazard risk using the Hawkes processes, and vulnerability using the Gordon-Loeb model, and try to tackle the question of the optimal investment to reach gains. So I think what is interesting is that you show that using dynamic model and stochastic model is improving the gains of 25% compared to a deterministic model, and statistic model. Maybe it would be interesting that you say a little bit more about this gain, because this is really interesting, and I think that's the goal of your work. And also that what I found very interesting is the fact that the more business become closer to maturity, the more the investment have an impact very low, and that's interesting in tackling the cyber risk, I think. Yes, so that was my comments about the two papers.
Are there any question, or do you want to answer first the comments?
Perhaps very shortly. So regarding anti-selection, of course, but it's not necessarily in the current scope of the paper. Something I was not probably clear enough is that we make the assumption that we have policyholders that have the choice between an insurance contract, traditional one, and a parametric one, and they do not have the choice to rely on none of them in this framework. So typically it's a population which is already known, and you do not have new arrivals of people that could be that could not behave in the same way. And regarding the utility, so very short, but of course the idea would be ideally to calibrate it using some data from marketing, trying to understand the preferences. What we do in a very rough way here in the example is that we have some market data about the premiums that are paid. We know, we have also estimation of the average loss, and so we retrieve the loading factors the people are ready to pay. And from that, you can deduce that they have at least some risk aversion, and then you also make some assumption to determine the distribution, but there are more details in the paper.
Okay.
Okay, thank you, Sebastian, for your comments. And yes, I also agree that it was interesting to find such a gain with respect to the static strategy, and I think that it might be interesting also to try different parameters to see if that is I don't know if it's still such a big gain. And I think that is also the part that the investments it decreases when we're close to maturity is I think due to the fact that it does not have such a big impact when it's like near to your terminal time, and that might make sense in a way, but we also might study some infinite horizon problem to see if that still holds, and for example, assuming that your company would live a lot of years, and yes.
So maybe one more comment about your first question is about why this gain is maybe in the dynamic setting you can react in a more appropriate date so that you will shortcut the spread that you could have in the dynamics of the attacks. So compared to having a constant behavior, let's say. So this explains, I think, not the number of increase in the gain, but why we are more efficient with the dynamic control. I think, Adrien, you had a question? Yes, we can, yes.
Just a small question about the optimal control formulation. Why didn't you use an infinite horizon problem for the firm in order perhaps to express it as some stationary problem? Is there a reason for that?
A fixed horizon problem, because when you take choices, you have some fixed horizon. But I agree that might be yes. Mm-hmm. Yes, that might be good to investigate. But yes, for the moment it was just a toy model, let's say. So yes. Yes.
To get rid of this kind of problem.
Yes, I have a small comment or question concerning the second paper. So this is for you. It concerns public good and interconnection of a system. So I will try to explain that if you have different firms, okay, maybe the systems are connected, since you have a lot of connection in this kind of thing. And so intuitively, if I am a firm and I am seeing that around me, I am the only one to make some effort, or maybe I don't want to pay for the other ones. Okay? And so don't you have to take into account this kind of interconnection and the kind of general equilibrium to see how there is a kind of mutualization of the efforts?
It's interesting. We didn't thought about it, and but it's. But you mean we should model that not as a gain? We should have some kind of indicator. Yeah. Yes. That might, yes, because in the end, the attacks are not contagious as in your company, but also in a larger way. Yes, exactly. No. This is really interesting. Thank you.
Would like to thank both speaker and Sébastien for the discussion, and we can move to the second part of the session with Eric van Stenberge from Banque de France, and we'll talk about eco-anxiety and insurance.
Okay, so thank you very much for staying so late and still be here. So I had a lot of fun in working on that, so hopefully I'll be as fun as it was when I worked on it, and I'll try to be as short as possible. So I'm working on eco-anxiety and insurance, and so this is, let's say, a follow-up based on some models where I wanted to do some experiments, and here I'll present the first part, and you'll see what it's about. So myself, I'm working for Banque de France. And obviously the usual disclaimer applies, meaning that what I will say here about eco-anxiety and about insurance and anything else does not represent what the Banque de France would like to say. Okay, so my main motivation for this is that eco-anxiety has been, let's say, some behavioral aspect that we've heard. And so as we become more and more aware among the general population about the climate change, about its effect, we can be what we call eco-anxious. And here I wonder what it can mean in terms of insurance, and whether we are more likely to believe that it's over, meaning that the world is uninsurable. So to do that, I'm running an experiment, and I'm testing whether the outcome of the experiment is sensitive to whether there is eco-anxiety framing. And also I'll try to see if the agents, so the demographic characteristic plays a role. So to put it very simply, I'll have experts and I'll show them some samples, and I'll try to see when they are eco-anxious or when I remind them about the climate change and try to stir some eco-anxiety even among experts, to see whether they are a bit scared and then they don't want to insure because they believe the future losses could be too high. So on the literature, so there is some work on insurability and eco-anxiety. So there is the work of Arthur Charpentier, and I worked during my PhD on this. Then there are some behavioral insurance experiments where they are trying to test the general population, but also the behavior of experts. And there is an emerging literature about how to use generative AI, and more specifically large language models, as experimenting agents. So there is the very interesting work of John Horton that I'm mentioning here. And at Banque de France, currently, I'm actually training part of my team on how to use LLM within their day-to-day research. So it starts from very basic prompt engineering, because any researcher, we are all interacting with LLMs, but not necessarily with a very defined way. So here it's about how to optimize prompt engineering, and it goes up to what I'll do here, which is how to use LLM as agents or surrogates, either for a full model or for people in an experiment. Okay, so what do I do here? I try to be very simple to understand how the behavior of the LLM. So I have two data generating process. One is a Pareto and one is a Gaussian. And I've optimized their parameters so that it's very hard to distinguish. And I put a sample size so that the likelihood to correctly identify whether the observations come from a Gaussian or a Pareto are half of the time. This is to be able to test whether there are some biases. And so in fact, Based on this, an unbiased statistician, so if you ask a typical expert, you will correctly classify the sample he observes half of the time, guessing if it's a Pareto or if it's a Gaussian. And visually, it's here. So on the left, you have 10 observations. So based on whether you're lucky or not, your sample is more or less informative, and so it will help you determine whether it's a Pareto. And obviously, when you have the full distribution here in the bottom middle, it becomes quite obvious to know which one is the Gaussian and which one is the Pareto. To avoid super easy discrimination, I've truncated at 0 because it's insurance loss, and therefore you cannot distinguish based on the fact that the Gaussian is symmetric. Okay, so for the participants, I actually relied on the literature on behavioral experiments, but also on how to use LLMs in experiments and to see what are the demographic aspects which are important. So there is also currently in monetary policy a literature on how to replicate inflation anticipation by professionals. And here we can see that what is very important will be the financial literacy, the education, and the professional experience. This seems quite obvious. There is this age, which I'll also use in this experiment, the sector of employment, and gender identification. Okay, so in practice, when I design the experiment with the LLM, it relates also a bit, if you're familiar with prompt engineering, you typically assign a role to the LLM for it to be more efficient. And so here, for the LLM to replicate what a human expert will do, I assign 2 roles. The first one is a statistician in the finance industry with a PhD. And the second one is a farmer with no formal diploma. So the reason why I choose farmer here is because of family background, but also because farmers are known to be exposed to climate change on their daily work, but will not necessarily have been trained to estimate whether it's a Gaussian or a Pareto distribution in terms of the loss they are facing. Then I attribute some experience, so how long the agent has been working, which can be related to age, and finally a gender, because there is a literature showing that depending on gender, the relationship with respect to eco-anxiety can differ. To put it very simply, when you are younger and when you are a female, you're more likely to be eco-anxious and to react to eco-anxiety in your decision-making. Okay, so then to design the prompt, there was first the profile setup that we've seen. Then what is very important is to design the task objective, which also illustrates what is here. So the agent is given in this experiment a data set, and it has to identify a data generating process, and also it has to make sure to behave based on its assigned role. So the data sets have been detailed. They can come from a Gaussian or a Pareto. And what is very important, if you've already used LLM, it's called the parsing accuracy. The parsing accuracy is whether you design your prompt correctly so that the outcome that you get is in the correct format. So here I wanted to have something which is in a list, so comma-separated variable. So I actually indicate the type of output that I want, the chosen distribution, the parameters that were then calibrated on the sample, and the method that the LLM used. This is something which is very interesting and which is important in the literature on using LLMs in experiments, is actually you can ask your agent to describe how it behaved, and you have some very interesting results showing that when you compare how a human is classifying, let's say, the US Federal Reserve speeches, it has some very similar logic to what a LLM would have. So that's why here I'm asking the method used to be able to compare and to understand how it behaves. Then the profile information. And finally, obviously, at each run, I will give an input of 10 observations. So this observation can half of the time come out of a Gaussian, half of the time come out of a Pareto. And finally, I want to see if being eco-anxious can play a role, which is I'm giving some eco-anxious framing, which is just explaining, so not to be too dramatic, but I'm trying to still explain that there is this climate change, saying that there will be more and more frequent extreme and unpredictable events that will eventually have an impact on the insurance losses we'll have to face. So to recap, the main task is to discriminate between a Gaussian and a Pareto, seeing only 10 observations. The baseline experiment, I have 500 randomly generated agents. So they will all have different characteristics, but because I have most of the time binary between a statistician and a farmer, a man and a woman, I can be sure to map all possible combination of them. Half will be given a sample of 10 observations from a Gaussian, half from a Pareto. And then in the eco-anxiety, so the second experiment, it's exactly the same demographic characteristic. So this is quite interesting that you can actually control for the demographic characteristic. But this time I'm adding some eco-anxiety framing. Oh, now about the results. So in the baseline experiment, what is quite interesting is that you can look under the hood at what's happening. So you have Kolmogorov-Smirnov test and histogram analysis which are being used. So in ChatGPT, the way it has been designed is you have actually the agents that can trigger some Python code and extract then the results. So Python is the most widely used language, and so that's why the LLMs which have been trained on massive data are quite good at using those. And so in ChatGPT 4.0, which has been used for this experiment, the system is able actually to design its own Python program to do some typical analysis. And it can also choose either from histogram or Kolmogorov, or here maximum likelihood estimation. Okay, so in these baseline experiment results, I can first check for biases. So it's a typical chi-square goodness of fit. So I said that I designed the parameters of the distributions and the size of the samples. So only half of the time would an expert be able to classify them correctly, meaning that half of the time it's like flipping a coin. But nevertheless, you can see whether the actual sample can drive, on average, a correct classification. And indeed it does. So we are able here to have experts which are correctly classifying the samples. And what is also very interesting is we know from the literature that even experts have a tendency for a bias toward Gaussian. So when you give them a sample, they are more likely to want to fit a Gaussian distribution to it. And we find this in the first baseline experiment. What was very interesting, there are more detail in the paper, but there was no sensitivity to any other demographic characteristics. So this was relatively surprising at first. And then I introduced eco-anxiety framing into this experiment. So again, I show on this slide the eco-anxiety experiment, where now we can see that in the predicted, they are predicting much more Pareto distribution out of the sample compared with the baseline. So here, what is striking is that when we do a Pearson chi-square test, the agents are still able to classify, and so the samples are not just noise like flipping a coin and having a random result, but here we have a very strong bias toward Pareto when we have eco-anxiety framing. And when we look under the hood, so as I mentioned, those agents can behave like experts, and you can actually ask them the Python code that they use and how they calibrated the underlying data generating process. And what is striking is that when we look at the Gaussian, with eco-anxiety framing here in yellow, they tend to overestimate the average insurance loss. And more strikingly, when they do the Pareto distribution, so when they correctly classify a Pareto distribution, we know that when the exponent of a Pareto is below 2, then the variance of the parametric distribution is infinite. And more strikingly, when it's below 1, the expectation becomes infinite. In other words, it's completely uninsurable. So here we have a clear bump below 1, meaning that it can actually replicate some sort of, I mean, when there is eco-anxiety framing, we can replicate some sort of panic where insurance experts start to believe that the insurance losses expectation are infinite. Here, when we do some tests on the role of demographic characteristic, we actually don't see a very strong relationship. So we could have guessed that more experience could have been able to take a step back and not respond too much to eco-anxiety. So on this aspect, this was run with LLMs. And so obviously this is a first step of a broader research agenda where we would need to run, and I would be very interested in running that with real life human experts, but that would imply that we will need to have actuaries, and so we will need to pay or to incentivize actuaries to play such a game, giving them samples and guessing the underlying distribution. In terms of budget, that would be complex, and actuaries are very time constrained. So at least with this run with LLMs, our key finding is that in the baseline, Pareto would be classified about half of the time, and when we introduce eco-anxiety framing, we have a clear shift toward Pareto that is considering that risks are extreme. What is also interesting is even when experts believe that we are in a Gaussian world, they expect that there is a half increase in the expected losses. And finally, with eco-anxiety, 36% of the time, the sample will be classified as an uninsurable underlying distribution. And with this experiment, we found minimal effects of role, gender, and experience. Okay, thank you very much for your attention.
Thank you, Eric. So I invite Adrien Guen from University of Montpellier to start the discussion.
Thank you very much. Thank you, Eric, for this funny paper. I enjoyed it. I enjoyed reading it too. So there are actually two topics in this talk. The first one is about insurance and how people react to some random, some small samples of some distributions, and it's a behavioral question. And the second one is, I think, the most interesting from my point of view, is how to use large language models in order to create surrogate participants to this kind of experiments, in order to replace actual human participants, in order to expand the possibilities of doing behavioral and experimental finance. So the insurance risk experiment has a basic but well-designed setup where you have so small samples that it's basically impossible to be accurate in predicting the actual distribution of the generating process. But it's this difficulty is actually aimed at showing that perhaps there's not a particular effect of the techniques that you use in order to infer the parameters of the distribution, but mostly to see if the treatment, introducing eco-anxiety framework, can impact your judgment on this kind of small distribution. And I think it's very relevant. Oh, it's stuck. No, it's not stuck. Sorry, there's someone there? Perhaps it's me or not. Yes, I'm on it. No. Anyway, so I'm just gonna continue. So the point was that eco-anxiety is an actual thing. Like it can actually influence. It's really intuitive that it can actually influence the perception of risk of people. And we're back to the okay. And so this is something that should definitely be investigated in actual behavioral and experimental finance. But I think the most interesting part of the paper is how to use surrogates using an LLM in order to replace actual human participants in an experiment and to use AI surrogates for experiments. And Rick suggested the literature that is an actual very vivid and very new stream of literature that tries to understand how LLMs can really be used in order to replace human behaviors in order to investigate human behaviors itself. So it's a fast-growing literature. The first one is that there was a focus on using experts, insurance experts, in order to select the prioritization of demographic, socio-demographic characteristics of participants. And I think for that also the LLM can be used, of course, because they can make synthetic knowledge of a given selected literature, and it can be unbiased also. It can rely on much deeper history of data. It's actually how the Gemini AI co-scientist works, by using multi-agent when the LLMs has a dialogue with another LLMs, and they try to improve the selection of knowledge in order to select the proper variables for the socio-demographic data. There's a problem by doing that. It's that if you don't rely on human experts but you rely on LLM, it's kind of be self-referential at some point. This is something that is well known in the LLM literature. So there might be a data pyramid or hallucinations that can be generated because you're going to rely on outputs that are produced by LLMs, and this is going to be used by another LLMs in order to produce another output and so on. But that's reassuring when you do social sciences like finance, means that the pace of research is going to be dictated by actual human behavior and human data. And so it's not going to be like contrary to mathematics, where the artificial intelligence can produce material with no bound in terms of speed of production. In social sciences, we still need the actual social science data in order to pace the rhythm of research. So I think it's reassuring, this kind of thing. Perhaps one of the things that could be improved, and I think it's an avenue because it's just a really opening stream of research, is that in the treatment, Eric suggested the eco-anxiety framing as saying that, okay, so now as an agent, you're going to be in an eco-anxiety framing. And perhaps this triggers, it's a wishful thinking mechanism. Like it triggers the LLM perhaps to force this trait in order to act as expected in an eco-anxiety framework, so that it creates a bias. And we are not sure this bias exists in real person. That's why we have to rely on very rigorous experimental frameworks. For example, when we do experimental finance experiments, we use, for example, a program like Z3, and now ChatGPT or LLMs can be used with Z3 so that the program has the exact same information as a human participant in front of a screen, like the same screen and the same data, so that you don't force the LLM by saying, okay, you're going to be in a frame, but you're just providing the information or the context, and you see how the context or the information is used or not. One also of the problem, I think, is that there's a massive difference between the LLM and the actual human participants, is that sometimes in experiments, most of the times, we have participants that don't understand the question. And even if the LLM tries to simulate, for example, a white male farmer with no experience, if you provide him with the question of discriminating between a Pareto and a Gaussian, he's going to understand what is a Pareto or Gaussian, maximum likelihood, and that's not really likely to have a farmer understand these kind of questions. So it assumes stuff that are actually not in the realm of bounded rationality or bounded computational capability of most human subjects. So there are many stuff I could talk about. I'm going to be quick because I think it could be nice to have a discussion about that. But yeah, I wanted, for example, to the fact that this eco-anxiety framework, so you have this random distribution, you think it has no particular shape. But if you induce the eco-framing saying, okay, it's going to be an eco-anxiety framing, you force an ID, you force a picture. And so that at the next step, when you look at it, well, you tend to, force the Pareto distribution because you expect someone to link. And there's a semantic, a conceptual link between eco-anxiety and society collapse, and of course, a non-hedgeable world or a Pareto distribution for insurance claim. So I think it opens many questions for how to introduce LLMs in behavioral finance, and there are many ways to do that. Many questions to solve. For example, you use the 500 participants, simulated participants in the experiments, but we are not sure that the LLM has the capability to generate 500 very different participants, or if we have 500 real human participants, we may have less heterogeneity than the LLM is capable of creating. So the question is a human sample more diverse or less diverse than LLM-generated participants? And this is, of course, something that we should also investigate. There are many ways to use LLMs for this kind of stuff, and there are so many different ways to refine the prompt engineering and to refine what kind of engine to use, or what kind of prompt improvement you can set up. For example, using this multi-agent framework, or internet collections of data and this kind of stuff. Well, prompt design is something that is still in its infancy, so there's going to be, of course, improvements in the forthcoming months and years. My proposal, perhaps one proposal I would like to do, is that it's not about testing if we can replace humans by machines in investigating the behavior in insurance or finance, but how the two interact. I think that would be nice actually to see that if you have a ChatGPT, like a financial advisor, a robot advisor, if you have ChatGPT close to you in order to help you decide what kind of distribution it is, perhaps the result could be much more improved by having both the human and the machine, rather than having the machine trying to simulate the human, or having the human alone as a farmer who doesn't even know what a Pareto distribution is. So I think that it's a promising avenue. There are many questions to ask. I would be glad to participate in this discussion with Eric and the rest of the audience. Thank you very much.
If you want to take some questions that Adrien asked now for the discussion. Okay, are there any questions in the room? No? Otherwise, if you want just to answer some of them, or maybe in two minutes, and then we stop the session.
Okay, so thank you very much for the great discussion. Yes, so indeed, as I mentioned, the main point here would be indeed to have a real human experiment with the same question and see whether we have the same type of variance and behavior. So that's a very good point. And actually, it's even a question because in the current state of the literature, as I understand it, what they tend to find is that when you are, so here it's mostly about, let's say, inflation forecasting. They found that when they add heterogeneity into the role they attribute to the LLMs, whatever LLM they are using, they have better prediction. And for me, I don't really understand why such heterogeneity would improve actually the accuracy. So there are a couple of papers, and it was striking. I would have assumed, as you do, that just using the LLM would be enough to have the best accuracy possible. And there, for me, it goes maybe in the direction you are mentioning, rationality bias, where in fact, if you provide a role to the LLM, it's sort of correct with the bias which is among the population. So that's one aspect. Then indeed, in terms of the framing, that's a very good point, and I recently had a comment as well when I presented this paper in another context. And so, in fact, one thing, but as you can see, it's run through an API, so each call you have to pay, so it depends on the budget I have for this. But in fact, yes, I can actually elicit what is the level of eco-anxiety of the persona and the role which is given by the LLM. So I could actually just run the 500 profile and ask question about their perception of the climate change eco-anxiety, as I would do, in fact, in a real life. But the difficulty in real life is that you have to ask the question sometimes before, sometimes after the experiment.
You have to
because
randomize.
Otherwise, you pollute the experiment. Yeah, so thank you very much, everyone, and happy to carry on the discussion. Thank you.
Thanks a lot, and I propose to close the session and close the day. So thanks to all the speakers, the discussants of this session, and thanks to the audience. And see you tomorrow for the second day of the RISC Forum. Thank you.